Imagine a normal morning. You walk into a coffee shop, reach into your pocket, and realize something feels wrong. There's no cash. Not because you forgot it, but because it no longer exists. No bills, no coins, no change jingling in your pocket. Every transaction, everywhere, now flows through screens, networks, and permissions. This isn't science fiction. It's a scenario governments, banks, and tech companies are actively preparing for. Cash usage has already collapsed in countries like Sweden, Norway, and Finland, where many stores no longer accept physical money at all. In South Korea, China, and parts of the United Kingdom, cash is increasingly treated as outdated, with digital payments becoming the default for daily life. Even in major cities across the United States, cashless businesses are no longer the exception. They're becoming normal. The question isn't whether cash is declining. The real question is what happens when it disappears completely. Why cash is being phased out? Cash isn't disappearing by accident. It's being quietly pushed aside by convenience, efficiency, and control. Digital payments are faster, cheaper to process, and easier to track. For governments, cashless systems reduce tax evasion and make financial flows visible. For banks, digital money lowers handling costs and increases data access. For consumers, tapping a phone feels easier than counting bills. But behind convenience lies a structural shift. Cash is the only form of money that allows direct ownership without permission. Digital money, by contrast, always passes through an intermediary. A bank, a payment processor, a network. Someone else is always involved. As cash usage declines, businesses stop accepting it. Once acceptance drops far enough, cash becomes impractical. At that point, eliminating it entirely starts to feel logical, cleaner, safer, more modern. But logic depends on perspective. What cash really represents. Cash is more than paper and metal. It's final settlement. When you hand someone cash, the transaction ends immediately. No approval, no reversal, no third party. This matters more than most people realize. Cash doesn't require electricity. It doesn't require internet access. It doesn't expire, glitch, or lock you out. It works during outages, disasters, and system failures. And most importantly, it doesn't ask who you are, where you came from, or why you're spending. When cash disappears, every transaction becomes conditional. Conditional on access, conditional on compliance, conditional on system stability. That's not inherently evil, but it is a fundamental change in how money works. Life in a fully cashless society. In a cashless world, every transaction is digital by default. Buying food, paying rent, tipping a driver, giving money to a friend, everything flows through accounts. This creates efficiency, but it also creates total dependency. If your account works, life is smooth. If it doesn't, life stops. There's no backup, no drawer of emergency bills, no way to operate outside the system, even temporarily. Losing access to your account doesn't just delay spending, it eliminates it. For most people, this isn't a daily concern. Until something goes wrong. Financial exclusion becomes invisible. One of the first consequences of eliminating cash is the silent exclusion of certain groups. Not everyone has stable internet. Not everyone qualifies for bank accounts. Not everyone can navigate apps, passwords, biometric systems, and constant updates. Cash allows participation without credentials. Digital money requires identity verification, system literacy, and ongoing compliance. When cash disappears, access to the economy becomes conditional on approval. This doesn't always happen dramatically, it happens quietly. A missed document, a flagged transaction, a technical error. Suddenly, someone can't pay for food or transportation, not because they lack money, but because they lack permission. In a cashless system, money exists, but access is negotiable. Surveillance becomes the default. Every digital transaction leaves a record: where you spent, when, how often, with whom. Over time, these records create detailed behavioral profiles. In a cash-based system, privacy is the default. In a cashless system, surveillance is. Governments argue this helps fight crime. Companies argue it improves services. Both may be true, but the cost is anonymity. Every purchase becomes data. Every habit becomes measurable. This doesn't require malicious intent to become dangerous. Systems built for efficiency can be repurposed during crises. Economic stress, political instability, or emergencies often expand monitoring powers. Once cash is gone, there's no way to opt out. You can't pay quietly anymore. The power to freeze becomes absolute. In a cashless society, money can be frozen instantly, accounts can be locked, spending can be restricted. This already happens today, but cash still offers an escape valve. Remove cash and financial control becomes centralized. Freezing assets no longer requires physical intervention. It's a keystroke, a policy update, an automated trigger. Whether justified or not, the power exists. This shifts the balance of power between individuals and institutions. Money stops being something you hold and becomes something you're allowed to use. Most people never notice this until they're on the wrong side of a decision. Negative interest rates become possible. Cash sets a floor on how money can be treated. If banks impose negative interest rates, people can withdraw cash and avoid penalties. In a fully cashless system, that escape disappears. This gives central banks unprecedented flexibility. They can charge people to hold money. They can encourage spending by making saving painful. They can directly influence behavior through monetary design. From a policy perspective, this is powerful. From an individual perspective, it's invasive. Money becomes programmable, not just how much you have, but how you're allowed to use it. Programmable money changes behavior. Without cash, money can be programmed with conditions: expiration dates, spending limits, geographic restrictions, category restrictions. Again, this isn't theoretical. Pilot programs already exist. Governments frame this as efficiency, targeted stimulus, controlled spending, but programmability fundamentally alters the nature of money. It stops being neutral. Instead of money adapting to human decisions, humans adapt to money's rules. This may sound extreme, but systems tend to expand once built. Tools designed for emergencies often become permanent features. System failures become systemic crises. Digital systems fail, networks go down, software breaks, power grids fail. In a cash-based world, outages are inconvenient. In a cashless world, they're catastrophic. No payments, no transportation, no food purchases, no fuel. Entire regions can grind to a halt because of technical issues rather than physical shortages. Redundancy matters. Cash is redundancy. Eliminate it, and you're betting everything on continuous uptime. Who loses the most? Those on the margins. The elderly, the poor, the undocumented, the technologically excluded. People who rely on privacy. People who distrust institutions for historical reasons. Cash protects minorities by being universal. Digital systems favor those who already fit cleanly into institutional frameworks. When cash disappears, inequality doesn't vanish. It becomes harder to see. The psychological shift. No one talks about cash feels real. You feel spending. Digital money feels abstract. Studies consistently show people spend more when using cards or apps. Remove cash completely and spending detaches from physical sensation. Debt feels lighter, risk feels distant. Overspending becomes easier. This changes consumer behavior at scale. A cashless society isn't just technologically different, it's psychologically different. Subscribe for more deep dives into finance, systems, and the future of money. And comment below, would you feel safer in a fully cashless world or more exposed? Thanks for watching.